The financial markets are a web of interconnected forces, driven by decisions, policies, and events from all corners of the world. Today, we're breaking down the major factors that influence market movement and how you can manage the risks. First up, the U.S. Federal Reserve. The Fed's decisions on interest rates, inflation control, and economic stimulus can send shockwaves across the globe. When the Fed raises interest rates, borrowing costs rise, which can slow down both consumer spending and business investment. In contrast, lower rates encourage borrowing and can boost market activity. The ripple effect isn't limited to the U.S. Markets in Europe, Asia, and beyond react accordingly. Higher rates usually strengthen the dollar, which can make commodities like oil more expensive for countries that import them, while lower rates have the opposite effect. The key risk? Volatility. Investors need to be prepared for rapid market swings in response to Fed actions. To manage risk, consider diversifying your portfolio and staying informed on Fed announcements. Keep an eye on bonds, as rising interest rates often make them more attractive to investors seeking stability. Now, let's move to the next topic: how events in Asia are influencing both crypto and traditional markets. Asia's economic landscape is crucial to global markets, especially in today's interconnected world. Trade agreements, market regulations, and policy shifts in major Asian economies like China, Japan, and India often have a direct impact on both traditional financial markets and the crypto world. For instance, regulatory changes in China on crypto mining or trading can cause sharp declines in Bitcoin and other digital currencies. To manage risks in such environments, consider hedging your positions with assets that typically perform well during uncertainty, like stablecoins in the crypto space or defensive stocks in traditional markets. Next, let's dive into Europe and see how the European Central Bank's policies shape the economic trends. The European Central Bank, or ECB, plays a key role in steering the Eurozone's economic health. Just like the Fed, the ECB adjusts interest rates and monetary policies to manage inflation and growth. However, its focus is on maintaining stability across multiple nations, which makes it a balancing act. When the ECB cuts rates, it's aimed at boosting lending and spending in countries like Germany, France, and Spain. On the other hand, tightening policies can cool inflation, but may also slow economic growth. Managing risk here involves watching how ECB policies impact the euro, which can affect exports, investments, and even commodities. Keep a close eye on policy shifts, especially if you're invested in European markets. Now let's talk about a major factor that's been causing a lot of volatility: global supply chain issues. The pandemic, war, and other crises have exposed how fragile global supply chains are. These disruptions lead to product shortages, delays, and price hikes, especially in industries that rely heavily on international components like tech and automotive. When key supply chains are disrupted, costs rise and company earnings can take a hit, causing stock prices to drop. This has led to increased volatility, especially in sectors heavily reliant on manufacturing and shipping. One way to manage this risk is through sector diversification. While tech might suffer from chip shortages, other sectors like energy or utilities may remain stable or even thrive. Lastly, let's compare the regional economic indicators that drive financial markets worldwide. Each region has its own set of economic indicators like GDP growth, employment rates, and inflation. In the US, strong GDP growth and low unemployment are bullish signals for markets, while high inflation can cause concern. Europe often faces slower growth but more stable inflation, while Asia's major economies like China and India show rapid growth but face their own challenges like regulatory hurdles or trade tensions. Keeping an eye on these indicators can help you predict market trends and make informed decisions. To mitigate risks, focus on global diversification and be prepared to pivot your strategy based on economic changes in different regions. In conclusion, managing risk in today's financial markets requires a global perspective. By staying informed on major events and understanding how different factors like Fed decisions, political events in Asia, and supply chain issues affect the markets, you can position yourself for success. Thanks for watching, and remember, knowledge is your best defense against uncertainty in the markets.